Great. So hello, everybody. Thank you so much for joining us, the Private Equity and Venture Capital Club and Fordham's Accounting and Tax Society, for our amazing event today with none other than Siddharth Singhai, which is the CIO of IronHold Capital. This event is basically Sid giving us a seminar on value investing, and there's no one better to be showing us how to do it other than Sid. And I'd be really, really happy to let Jay and YL take it away from here. So.
Hi guys, I'm Jay, and I'll just be giving a quick intro for Siddharth. So Siddharth, thank you so much for taking your time out of your busy schedule. We know you're really busy, and I don't think you want to do this on a Wednesday night, but here you are, Thursday. So Siddharth comes from a non-traditional background. So he did his bachelor's in mechanical engineering. And then after that, he worked as a lead equity research analyst for capital-based financial advisors, where he applied value investing principles, which we'll be talking about today, to emerging markets of India. He's also researched on the Indian economy, has published in leading journals like in the financial journals, the International Journal of Multidisciplinary Research. He also holds a master's in global finance from Fordham, the Gabelli School of Business. He also been featured in leading business journals like Forbes, Business Insider, Hedgeweek, Valuewalk, and Alphaweek. I'm going to let Sid take away from here.
Thank you for the very kind introduction. It's my pleasure to be here, speaking to students of Fordham University. Thank you for inviting me. And I do have a presentation for you guys that I will pull up in a second. I'll just go over some of the fundamentals of value investing, what it is, and we'll cover a whole bunch of topics related to it. These include what is investing in general, what is value investing, why you should invest for the long term, qualities of a value investor, how do you actually invest, what is margin of safety, and I'll give you guys an actual real-world example of how you can go about it. So, what is investing? Investing is making money from money. Essentially, we take our money, we deploy it, or we buy some assets. Assets could be anything: stocks, real estate, gold, silver, commodities, like copper, any of those things. Even Bitcoin or art pieces, exotic luxury cars that are rare. And the goal of successful investing is to make money from these assets, right? Either through appreciation or through yield, which is really cash flow. But that is in general investing. Now, why value investing? Well, value investing is, a set of time-tested principles. It's been successfully applied by some of the world's greatest investors. As you can see, Mr. Seth Klarman, Mr. Greenblatt, and the great Warren Buffett himself. And it essentially involves thinking of yourself as a business owner rather than somebody who's a stock trader or investor, and buying something for less than what it's worth. Mr. Buffett would say, I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor. Essentially, you want to think like a business owner, not, as if you're owner of some ticker that goes up and down in value. And this is what I mean by that. Stocks in the short run, as you can see that gray curve, in this case, market price, they are inefficient or random. Can you guys hear me? Right, okay. So, stocks in the short run are inefficient, which is to say stock prices are random. You cannot really predict them. And so any kind of technical analysis or trend-based investing or investing based on very recent news is most likely to result in not great investment returns. What you want to do is invest for the long run. Why should you invest for the long run? Well, in the long run, the quality of the business, or the performance of the business rather, and the performance of the stock is pretty much the same, as you can see here. In the short run, the stock can do pretty much anything. Now, what is the performance of the business? Well, it's the growth and intrinsic value of a business. What is intrinsic value? Intrinsic value is all the cash flows that business will produce over its lifetime, 10, 15 years, discounted back to present time. That is the value of every business. And if you can buy for less than what that value is, which is right here, is underpriced, when the stock is temporarily depressed for any psychological reason out there, that is where you build your position and then you hold on to it. Eventually, as we know, markets are efficient over long periods of time. Intrinsic value of the business and the market value of the business, or the stock price essentially, are going to be the same. So your job as a value investor is really to, first of all, figure out intrinsic value of a business. And then, the stock price is easily visible and you make a decision whether you want to build your position or you want to cut your position if it's overpriced. So that's the nature of the market. And it's very important to understand it. So, compounding, right? What is compounding? Well, imagine having a snowball, right? Small one at the top of a mountain, and you roll it off. What would happen over time is that snowball will get bigger over time without you putting any effort into it, right? And same thing happens with your money. If you let your money, no matter how small the amount is, if you let it roll down the hill, or essentially grow over time, let's say 20, 25 years, you don't have to keep investing a lot of money. The time, or the compounding of time, that will take care of the amount that you will receive at the end. And this is a great realistic example that explains that. You invest $2,000 monthly over 25 years, and you assume a 9.14%, or let's say roughly 10% return on your investment, which is not extraordinary. It's the average you can expect. And initially you start out with $1,000. Over time, right, 25 years, that amount will be around 1.4 million, right? So the key is to start early. It doesn't matter if you start small, but if you allow your money to grow over time, you don't have to invest very much, right? $2,000 a month is not an extraordinary amount for a lot of working professionals. And 9% to 10% returns are what you can expect from your S&P 500 index if you just own that. So essentially you have to do nothing to make this money. You invest it and you let it grow. Now, you might ask, why long term, right? Why can't you predict the short term? Or why should you, go so patient and, wait for the market to be efficient? Well, first, it's almost unpredictable, the market in the short run. Very few people are able to do technical analysis and actually make money in the market. And second, if the economy is doing well, right, the market over long periods of time is going to do well. And this is actually a good representation of that. We had a number of crises, over the last 50 or 60 years. 87 market crash, Mexican peso crisis, World Trade Center attacks, the mortgage meltdown, subprime mortgage meltdown, bankruptcy of Lehman Brothers, and COVID very recently. And so, as you can see, market is driven by psychology, and people do get scared, and they do, respond negatively to these events. But as long as the underlying economy, in this case, United States, is doing well, there's no reason why the overall stock market shouldn't. And this is a great example of that. So if you invest for the long run, short-term events, no matter how major they might seem in the moment, don't really have much of an impact. In fact, they're a great opportunity to build positions in your favorite companies. So what's the psychology behind being a value investor, right? There are four things that you have to think about majorly. There are a few others, but these are the big ones. You need emotional stability. You need patience. You have to say no to almost everything, and you have to think in bets. Now, emotional stability and patience. These are two great companies, Berkshire Hathaway and Amazon. But even then, they did, if you look at the stock price, they did go down by a lot during dot-com bubble, Great Recession, COVID-19. And, if you got scared, if you were emotionally, too driven by what other people were doing in the market, and you did not have the calm or the guts to hold on to these stocks, you would actually sell at a loss, right? And so you need emotional stability. You have to have the facts, and you make your decisions based on those facts. In addition, you have to wait, right? These things last for anywhere from 8 to 12 months, depressions, recessions. And if you're impatient, if you want to make your money quickly, you will get punished for it in the stock market. But if you are wise, if you understand what the intrinsic value of Amazon or Berkshire Hathaway or any other businesses, you can come in at a price that's very attractive, that was available to you during these recessions. And you just hold on to these stocks and you'll do well. So emotional stability and patience. And then the other qualities are more related to how you actually invest. So you have to think in bets, to say no to almost everything. The third is probably the most important one, have a margin of safety, right? Thinking in bets, right? We all take risks in our day-to-day life. You go to the beach, you take some risk. You can get attacked by a shark, right? The probability of that, as you can see, is extraordinarily low. You can get hit by lightning. That's also pretty unlikely. Car accidents are, it's not that unlikely, but, still take that risk. So that is, the real world. Nothing is assured. You have to think in bets, and you have to understand what are the odds of your success or failure when you're investing. So you have to find situations where your downside is limited and your upside is huge, it's exponential. And if you can do that with stocks, and from time to time you do get the opportunities to do that, then you'll do well. So think in bets, right? What's my downside? What's my upside? And is it asymmetric? Second is, let's say you're looking to get married, and there are millions of people out there that can be potential suitors for you. How will you go about this, right? Marriage thing. You're going to apply a set of filters. You're going to look at a bunch of qualities that you desire. And based on that, you're going to filter through hundreds of thousands of candidates. And then what would be left is worth further inspection, right? And same goes for stocks. There are over 3,700 stocks in the US. And you don't have to be right on, even 1% of those. You need 15 great stocks, and that's pretty much it. So in order to get to those 15, you have to say no to almost every other stock. And so you need good filters. Good filters will allow you to quickly sift through investment opportunities that are great and that are not so great. And that's why there's scope, right? Very successful people say no to almost everything. Makes a lot of sense. Lastly, if you've ever noticed, right, elevators have a limited capacity. You can only take maybe 8 to 12 people at a time. But let's say you decide to do something crazy and you take 15 of your friends with you on a capacity of 12. It wouldn't mean that you guys are going to get injured or dry, or there's not going to be an accident essentially. Reason for that is the engineers, when they were building out these elevators, knew that human beings are not perfect, and they had already built in a margin of safety in advance. Take care of that. And that's what you want to do with your investments. In case you're wrong, about your predictions of future cash flows, you want to buy things for cheap. So even if you are wrong, you don't lose your principal. Same can be applied, for when you're building bridges. You want bridges to hold, twice as much as, everyday traffic, because, weird things could happen. There could be high intensity wind. The material might lose its, strength over time, and you have to account for all of those. And so you just take a big margin of safety. Well, this is a good example of an investment that, we think will, that possesses all the qualities of great investment, I should say. And full disclaimer, we do own positions, and so should not be construed as investment advice of any type. That being said, Lear Corporation, it's a leading seat manufacturer in the US. The three big metrics that you will see on your screen: ROIC, net debt to shareholders' equity, discount intrinsic value. What are those metrics and why are they important, right? ROIC is a measure of quality of a business. And, average business in the US earns a return on invested capital about 10%, 15% would be really good. Lear earns 40%, and it's done so for a long period of time, well in excess of 40%. So it's a high quality business. It has net debt to shareholder equity of only 22%, which is almost no leverage. Now remember, you want to have some leverage so that you are taking use of the low interest rates that persist right now. But, it's a pretty comfortable level of debt that they have. So they've got a strong balance sheet. And when you buy the stock with 33% discount to intrinsic value, it has a huge margin of safety built in. What that really implies is that if the stock could fall by 30%, your principal would still be protected. And that is assuming your valuation of intrinsic value is somewhat accurate. You don't have to be exactly right. And, so this stock is high quality. It's got a safe balance sheet, and we bought it for cheap. And what we think will happen over time is, the blue line that you see, the intrinsic value, we believe it's 240, around that region, 240, 260. And we built our position at 140, obviously. And what we hope is that over time, stock price, now of course, the blue extension that you see here, it's probably not going to happen that way, but it is something that we expect to happen over time. That 140 eventually will intersect, the market price will intersect with that blue line, and that will be your return, right? So I don't know what the stock price is today, but it has moved since. But that's sort of how you can think about, the stock market. So, that will be the end of the presentation, and more than happy to take any questions.
So thank you so much, Sid, for having that amazing presentation. Very, very informative. So yeah, any questions? We actually had one a little bit earlier. It's not related directly to value investing per se. It was Annie who she said, does Bitcoin have intrinsic value? And if you guys want, we'd be more than happy to have you guys put on your screens to engage with Sid and, ask whatever questions you want. So feel free to turn on your mics and cameras.
To address that question, right? Bitcoin is a tricky one. I personally do not think there's any value there, because why is Bitcoin 100,000, right? Or 50,000, or why would it be $1 million in the future? You have to ask that question to yourself. And, what is so special about Bitcoin? Well, the technology blockchain, which is really, a more like it's an anonymous way to transfer money, and it's got checks and balances that makes, sort of corrupting that data or whatever you're transferring very difficult because of, blockchain is really, you get a bunch of blocks with each individual signatures in sequence, and that signature gets, when you mine a Bitcoin, essentially you solve that problem, you create that unique signature, and if it doesn't get verified, it's not possible for you to break into the chain. It's a way, simplistic view of blockchain, but that's essentially what it is. And blockchain has a lot of applications, right? If you're buying, let's say, fashion bags, or anything that you want, something that was made originally in Paris by let's say Louis Vuitton, and you don't know if this is an actual original or is this a copy. In those cases, blockchain has value as a technology. Bitcoin to me is really like a digital credit card. And when you say Bitcoin itself is worth like, whatever, 50,000, you're really making, at least according, in my view, they claim that the plastic credit cards or debit cards themselves have value of thousands of dollars, right? So it has some intrinsic value, maybe, but 50,000, there are too many cryptocurrencies out there. You can start your own pretty easily. You've got Doggy Coin and kinds of things. So what's so special about Bitcoin, right? It's not rare. It's rare as in you cannot produce unlimited Bitcoin maybe, but you can produce unlimited cryptocurrencies. So it's a tricky one, according to me, I think. Yeah, can't really put a value on it. So probably a speculative problem.
Thank you for that question. And Sid, thank you for that really, really great insight. I know Anosh also has a question. Anosh, if you want to turn on your mic or camera.
Sure. Yeah. Hi, Sid. Thanks a lot for this presentation. Just a quick question. Again, I'm very blank in this space. This is not something that I've really dealt with or gone more into. So just wanting to know if for somebody who really doesn't have this kind of a background, but wants to start investing in stocks, how do you really go about it maybe at this stage? Or what exactly, where do you look for it? Or how exactly do you find out which ones are the best ones? Because I know everybody always goes for the bigger companies or seeing what's more valuable in terms of stocks, but how would you suggest somebody about it when they don't have much knowledge of it?
So I would say I would warn against getting into the stock market without having at least a good 4 or 5 years of experience, in my view, because it is a special field, right? And you do want some knowledge of what businesses you own, and it's very difficult to beat the market, as you guys would know. So I would say get the knowledge first. Now, if you're talking about how do you sort investments, right? That's a different question. We typically have filters, as I just talked about, and they allow us to have a universe of stocks that are cheap, high quality, and safe. Got a strong balance sheet, and we take it from there, and we verify if our assumptions about the stock are true or not. So we use screens, and we adjust parameters on those screens depending on what our opportunity costs are, right? How aggressive can we go? But investing, if you want to get started, I would say start with the classics, Security Analysis, Benjamin Graham. It's a great book. I think that's something you can start off with.
Thanks.
Any other questions? You guys can just turn on your mic and turn on your camera. Feel free.
Hi, Sid. Thanks again. I actually have a quick question. This is kind of relating to COVID and what you're seeing now as the companies that lost a lot of liquidity in the past start to come back once the vaccine helps and companies start to come back stronger. Do you think there'll be a shift away from value investing into growth investing? Or what are your thoughts on what the next 5 years are going to look like?
Well, I mean, that's a fantastic question. Because value investing is a very tricky word because the ways to go about it. If you look at investors like Ben Graham of the old, they would just look at, if I take an example of a bakery, right? If you own a bakery, what is that bakery worth when it's dead? Or when you shut it down, you sell everything. So if you buy chimney or utensils or whatever, all of those put together are worth, let's say, $500,000. And if somebody's selling you this bakery for $300,000, you are essentially buying it for cheap, and the assets themselves are worth $500,000. That is one type of investing. You just buy cheap things. What's the physical equipment, the location, the building itself, what? So that's one type of value investing that could be out of favor. That I'm not sure that will persist in the future or not, because we have moved to a very service-heavy economy. The second type of value investing is really, more in line with what we do. We look at cash flows. What does the business actually make every year? And we discount that back. We get the value of that business. We try and buy it for cheap. Now, growth is actually part of value. So they're not two different things. If you can find a company whose value is growing over time, right? I just do pull up this data, right? So in this example, you can see the blue line, right? Here. And that blue line, as you can see, is not straight. It's actually growing, or it's actually at a slope. So the intrinsic value is increasing over time as well. And those are the best kind of businesses. The high quality, the cheap, and the growth. And this business is not growing at a very rapid rate, as you can see. It's going around 2-3%. But if you can find something that's growing in addition to all of that, that's growth investing and value investing combined. I don't think growth investing in of itself is, if you were to sell, a dollar bill for 99 cents, you will sell a lot of those, right? And you could possibly grow way fast doing that. Your business of selling a dollar bill for 99 cents, but you will never be profitable, right? So growth without any, when I talk about quality, is useless, right? So growth investing and value investing to me are tied at the hip. They're sort of part of each other. I don't know if that answers the question.
Yeah, perfect. Thank you.
Sid, I had a question. So what's your investment horizon usually like? Because value investing is a long-term strategy, obviously, and it might take, if you like invest in an asset which you think it's undervalued, it might take years for it to reach the value or exceed the value. So what's your strategy over there? How long do you think it takes for you to get your money back or increase in value? And what do you do in the short term while you're waiting for your investments to reach the level you think they will?
Well, what we do in the short run is really we do more research and we try and identify more opportunities, because you can't really influence when the market will agree with you. When I say when will the market agree with us, it's really that green line. When will that meet the blue line at that point, right? When it will grow enough to coincide with that. We don't know how long that will take, right? I assume typically 2 to 3 years is when market efficiency kicks in. And, you know, that is what I expect on average. That's been my experience of, you know, you can sort of verify yourself, but it's not a given. Could take slightly longer, could happen within, 2-3 months. So the investment horizon also depends on if the business is growing, right? So if I'm buying Amazon, bought it for cheap, right? Amazon was worth 1 trillion. I bought it for 700 billion, right? Just, you divide that by market number of outstanding shares, you'll get the market price. Do I have to sell it once it gets to 1 billion? Not necessarily, because that 1 billion is also growing at 20-30%. So if the business is not growing, this blue line is flat, then there are no further profits to be made, right, by holding on to it. But if this blue line was growing at like 20%, I would keep holding on to it.
Great question, Sid, and thank you. Oh, great question, Jay, and thank you so much, Sid, for that explanation. I know we have a few more questions. Feel free to jump on, guys.
Hey, Sid, I have a question. Well, thank you for the presentation. Super insightful. If there was one or whatever takeaway that you've gotten from your MBA experience and moving on to, like life outside of something like an MBA, what advice would you give us as, students who are about to graduate or will graduate from a year from now, especially of those that are looking into something like, private equity or finance? Any advice?
So I think the one piece of advice that really works, I think, is Arnold Schwarzenegger came up with it, was work hard and advertise. So if you guys are, and you could be doing anything, right? Private equity, venture capital, hedge fund, or fintech. You have the work, but you have to also push it out so that people are aware of that work. And you can't just market, you also have to have the work. So yeah, my advice would be to work hard and advertise. If you can do it through networking or multiple ways to do it.
So Sid and Paul make a great team. Paul is also like a master networker and Sid is like the brain. So I think Sid is also a great example of picking an awesome co-founder as well, right? And really merging two talents to build a brand and a team, because you can't build a company alone. So I feel like Sid and Paul really are a great example of that. I actually have a question of my own, Sid, if I don't mind, if you don't mind me asking. Right now, economically, we're not producing much. Our economy is, I don't think it's ever produced this little, right? And we just printed, I think, the most money we've ever produced in ever in American history. How do you think that's going to affect the markets moving forward, especially in the coming months? And what can we expect? What are you seeing?
Well, so I think the one thing that wasn't in the presentation was when you think of macro, right? Interest rates, exchange rates, inflation, all those things. You want to be macro really plays no part in what we do, mainly because it's unpredictable, right? Nobody predicted that, could have predicted that we could have 10 years of like rock bottom interest rates with no inflation, even after printing so much money. And people haven't been able to explain that. Best economists disagree with each other. So it's not a settled science, right? Macro. So the best cannot do it, fortunately. My assumption would be, and this could be completely, ridiculous. The reality could be completely different. I think you're going to have normalized interest rates, 4-5%. Inflation of around maybe 4-5% as well. You might see the market, it might tumble. I'm not sure how it will happen, when it will happen, but it could decline by as much as 30 to 50%. And, with the US deficits as they stand, I'm not sure how that problem will be solved. I most likely think US will inflate away its debt. So I don't think there's any structural problem apart from that debt. That is a big one, but US should do fine over long periods of time, as you just saw in that graph, 1957 to 2016, I think it was. So, economic downturns are inevitable. It will happen at some point in time. There will be a market crash. We don't know when exactly or how, but that's my expectation for it, and higher inflation could be wrong.
Thank you for that.
Hey, Sid, I just had a quick question. Really like the presentation, and thank you so much for being here. I was interested to learn where you do your research, like any publications or news sources you like, or where do you typically go to find your information?
I think there's a good resource called Value Investors Club. It's a forum where you can find a lot of great investment ideas, probably the best one of its kind. Others, some zero, is also pretty good. And but typically you can't really look at, unless you know the investor, right? So if you know, let's say Mr. Buffett made a position in this company, there's a good reason behind that, and you can try deconstructing that. But it's Mr. Buffett, right? So you can look at holdings of other great investors out there, and you can clone that, right? Sometimes you won't be able to figure out, why he made that position, but other times, you can, especially with other value investors, deconstruct that position. Right? So it's a good way to generate ideas, but I think mostly it's not going to be useful for you if you're a small capital base. You should look at smaller market caps, right? If you're looking personal investments, which big investors wouldn't touch because it's not going to, they go up by 20 times, it's not going to make a dent on their portfolio. It's not worth their time. So apart from those two resources, reading through the holdings of the great investors, Wall Street Journal is good, right? Wall Street Journal for microeconomic stuff. Yeah, trade publications of, Economic Times, Wall Street Journal, all of these.
Great, thank you.
Hi, Siddharth. I had a quick question. Thank you firstly for the presentation. When we look at value investing, how important does diversification play a role? Because if we look for the best 15 stocks, then can it be in maybe 2 or 3 sectors, or do we diversify into multiple sectors?
That's an incredible question. Because think about it. I mean, you're right. You need at least some diversification. You don't want to own, let's say, 10 airline stocks, right? They would have gotten decimated during COVID. permanently decimated. So you want, I would say, 4 to 5 industries, 6 industries, right? And really high quality businesses with strong balance sheets. So something will go wrong, something that you cannot predict will happen, like COVID. And if you have all the money in one sector, one type of company, you could wipe out your wealth very quickly. So there's no fixed number for it. I mean, if you have, let's say, semiconductor company, auto company, tech company, restaurant chain, and let's say one other type of business, laundromat chain or something like that, then I think your sufficiently well diversified, right? Less correlated the businesses, the better. But yeah, the important point would be to not go over 20, 25 stocks, because when you demand high quality, right, when you talk about the filters, very few companies will match that criteria, right? And you cannot dilute you cannot have 60 stocks and you put 0.5% each or something like that, these stocks, that you're not gonna, you're just better off owning the index in that case. So if you're looking to beat the market, you have to be concentrated. 20 great businesses are more than enough. Like great investor Bill Ackman owns, I think, 8 to 10 positions, and he's managing, I think, in excess of 10 billion now. So that's that's a lot of, that's as much diversification as you need.
Thank you.
We do have a question from James Lee. If you do want to turn on your mic, James, and ask. Okay, seems like there's a bit of a delay. But he asked, have you looked at Chinese stocks and found any interesting value opportunities?
Unfortunately, we don't look at China. Our focus is India mainly and US. So I can't really give you anything. I'm sure there are great companies there that you can look into, but I don't have the expertise in that region.
Thanks, Sid, and thanks, James, for the question. So guys, any more questions? Okay, so I'm gonna let Jay take it away from here.
Thank you, Sid, for coming here today and talking to us about value investing. I feel it's like a topic no one really talks about much these days. Everyone wants quick returns. They want to short something. They want to get quick money. And I think this was really interesting, and I would be looking into it even more. But on behalf of PEVCC and the FACTS from Fordham, we thank you so much for coming here today, taking the time out. And it's always good to hear from someone young and a Fordham alumni, as it gives you more hope to find a job, to do something better. So thank you so much.
Well, thank you for inviting me. It's my pleasure to be here. And thank you, Avneet, for putting together the event. Thank you.
Of course, thank you, Sid. Everybody, please give him a round of applause. We applause.
Thank you, guys.
Yep. Thank you guys so much.
Thank you. Bye-bye.
Have you all have a great rest of your evening.